Welcome to this tutorial on Webull margin account versus cash account, where we will guide you through the key differences between these two types of accounts. As a beginner or experienced investor, understanding the distinction between margin and cash accounts is essential for making informed decisions about your investments. First, let's start with the basics. A cash account is a type of brokerage account where you can only trade with the available cash balance in your account. This means that you cannot borrow money from the brokerage firm to purchase securities. On the other hand, a margin account allows you to borrow money from the brokerage firm to buy securities, using the securities in your account as collateral. The main advantage of a cash account is that it eliminates the risk of margin calls. A margin call occurs when the value of the securities in your margin account falls below a certain level, and the brokerage firm requires you to deposit more cash or sell some of your securities to bring the account back to a safe level. With a cash account, you will never receive a margin call, as you are only trading with your available cash balance. However, a margin account can provide more flexibility and potential for higher returns. By borrowing money from the brokerage firm, you can purchase more securities than you would be able to with just your available cash balance. This can be particularly useful for investors who want to take advantage of short-term market opportunities or invest in a diversified portfolio of securities. It's also important to consider the interest rates and fees associated with margin accounts. When you borrow money from the brokerage firm, you will be charged interest on the borrowed amount, which can add up quickly. Additionally, margin accounts often come with higher fees and requirements, such as minimum balance requirements and maintenance fees. To illustrate the difference between margin and cash accounts, let's consider an example. Suppose you have $1,000 in a cash account and you want to purchase 100 shares of a stock that costs $10 per share. With a cash account, you would be able to purchase 100 shares of the stock using your available cash balance. However, if you had a margin account, you could potentially borrow an additional $1,000 from the brokerage firm to purchase an additional 100 shares of the stock. In conclusion, the choice between a Webull margin account and a cash account depends on your individual investment goals and risk tolerance. If you are a conservative investor who wants to avoid the risk of margin calls, a cash account may be the best choice for you. However, if you are a more aggressive investor who wants to take advantage of short-term market opportunities, a margin account may provide more flexibility and potential for higher returns. Always remember to carefully consider the interest rates and fees associated with margin accounts, and to never invest more than you can afford to lose.